Welcome, everybody. It looks like we still have people streaming in, so we're going to wait just a couple of minutes, but thanks to everybody that's logging on here. Looks like the waiting room is opening up pretty quickly. Or I shouldn't say the waiting room, the webinar. Let's just give it about one more minute. All right, I think we should kick it off. What do you say, fellow panelists? Should we let it roll?
Do it.
Let's do it.
Let's do it. All right. This is an absolute pleasure to talk about. We are all so ridiculously excited about this opportunity. I'll kick things off. I'm Shannon Aronson. I know an awful lot of you on the webinar. I have been in real estate for 23, 24 years, first and foremost as an investor. Also have been in residential real estate sales. I own 3 brokerages with some partners, with about 700 plus agents. So real estate is just about all I know. And this deal is as exciting as any I've seen in all my years. Glad to have you guys here tonight. Zach, I'll kick it over to you.
Yeah, and can we just go to the next slide? Yeah, thanks guys. Good evening. Thank you all for hopping on the call. Just a quick background on myself. In my day job, I work as an asset manager for Deutsche Bank. I've worked on over $4 billion worth of total loan commitments. While working for Deutsche Bank, I currently have a portfolio of over $300 million worth of assets that I'm the asset manager for. Before working as a professional asset manager, I worked for Newmark Knight Frank as an appraiser in New York City. So I've appraised buildings like the Empire State Building, the Chrysler Building, One Vanderbilt World Trade Center, and have a strong background in underwriting deals as well. And for these deals, I'm going to help with the asset management for this deal. And Jennifer, you want to go next?
Absolutely. Well, my name is Jennifer Barner. I've been in real estate since 2015. Previous to that, I worked at IBM and Microsoft. I'm super excited that I found real estate and get to be part of this. I started putting homes in a portfolio, and when I realized that I couldn't get the economies of scale and grow fast enough, I found multifamily, specifically syndication. So I'm now the general partner and sponsor on 1,094 doors, and I'm a limited partner in over 2,000 doors. So super excited to be here and share this opportunity with you. And Jonathan, I'll turn it over to you now.
Thank you, Jennifer. John Wells. I'm based out of Charleston, South Carolina with my beautiful, talented wife, Sam Wells. She's the better half of this operation. Unfortunately, she couldn't make this call, so you're stuck with me. I'll try to fill in as best as I can, but so we're in just over 800 doors as general partners and operators, and we are a vertically integrated asset management company with and with assets within 2.5 hours of Charleston, including Savannah, Augusta, and Charleston is our main focus. So glad to be here. Thanks for having me.
Thanks for coming. And Jonathan, I think we skipped that disclosure slide, which I know is your favorite, the disclaimer slide. So you just want to cover that as well?
Sure, absolutely. is the slide on here? That
Yep, it's one
disclaimer?
back. There we
Okay,
go.
perfect. If you would, you can feel free to pause the recording when you look at it and read through this, but essentially what this is saying is this is not the actual offering that we're providing here today. This is just a high level overview and answer any questions and put things in layman's terms where we can all understand it. The actual offering is a private placement memorandum document that is in the portal where your sponsor will give you a link to review that. So just want to make that clear.
Awesome. All right, let's kick it forward. And Jonathan, why don't you tell everybody about this fabulous location?
Absolutely. Savannah, Georgia. So when we find an asset, we always buy the market first. That is absolutely crucial. It really doesn't matter how good the deal looks unless we check all the boxes in the market that we're looking for. So bare minimum, we want to see at least 100,000 people in the MSA in the market. We want to see 20% population growth. We want to see career diversity. We want to see job growth. We want to see a minimum income, median income of 45,000. And we want to see a median household value above 200,000. So this checks all those boxes. Savannah, over 400, or right at 400,000 people, tons of jobs, which you'll see, tons of tourism, and a big markets moving here. A lot of big names are moving to the Savannah area. The film, TV industry has been in this location for a long, long time. You got Briggs and Stratton, Georgia Pacific, my alma mater, Georgia Southern University. Gulfstream makes airplanes. SCAD is Savannah College of Art and Design, a world-renowned college where people all over the world come to go to school here. And the downtown area is absolutely fabulous. If you've never been to Savannah, I highly recommend it. It is like no other city in the world. It is extremely charming, and you just got to go to really experience it. It's not like your cookie cutter American city. It is truly unique. So one of the slides is on some of the big names that are coming here. As Hyundai is putting in a massive, massive plant. I'll get back to this slide, but they are going to be, it's about 30 minutes from this asset. They're going to be producing over 8,000 jobs in the area, and over 300,000 electrical vehicles will be produced from this plant. It is absolutely massive. When you drive by it, it's basically another city. The previous slide, I'm sorry for skipping ahead there, but shows that population growth. Again, our baseline is 20%, which is extremely good for growth. Savannah is at 30%, and this submarket is Southside Savannah. So it is exactly what we're looking for: workforce housing, tons of retail. It's right in the middle of two booming, very busy malls, and you also have the Army base right next to it. So yeah, that's Savannah. Just a little bit more on the Hyundai plant. It's not just the plant itself, but all the satellite industries that will spawn off from this, that supply that Hyundai plant. That's a big deal. So, and world-renowned St. Patrick's Day, we go there every year. All the in-laws live in Savannah, Georgia, about 10 minutes from this asset. So we visit it quite often, at least twice a month. If you ever get a chance to be at the St. Patty's Day, it is phenomenal. Lots of fun.
And Jonathan, I think you mentioned that, I know you go there still a couple times a month to see family, and Samantha grew up there, so she knows it very, very well.
Mm-hmm. Extremely well. Yeah, she born and raised in Savannah, my wife, and like I said, all the family still lives there, so we are there quite often. And we already actually own an asset with the same team in that submarket. So I know you'll talk more about that.
Yeah, we will. All right, so I'll take it over a little bit from there. We are really excited to talk about this asset, as Jonathan said. It was built in 1976. It already has an occupancy rate of about 92%. If we took this asset over, did absolutely nothing, this thing is already cash flow positive, which is a really nice place to be. It's got a great mix of 1, 2, and 3 bedrooms, which is exactly what we like to see. If you look at this slide, it talks about the rent per square foot, the rent per unit, and don't switch slides yet, please, but we will talk about where the rents are now and where we want them to be. It's a nice building. It's got a playground, as you can see. It's got a dog park right next to the playground. It's got a pool, on-site management, fitness center, laundry facilities. Even though most of the units do have laundry within them as well, there is an extra laundry facility there. There's a nice outdoor gazebo area with some barbecues. So it's a great place for family or anybody really to live. There's some pictures, some interior pictures we're going to look at on the next slide that can kind of give you a sense of what these look like. The kitchens are a little bit inconsistent, which is why we have some work to do to be able to improve some of them and increase the rents. But for the most part, they're in decent shape. They just need a little lipstick and jewelry on them. So we're going to be ripping up some carpet, putting in some new flooring, painting cabinetries in some instances, countertops, some hardware, some lighting. This team has a really good track record of coming in, spending a very conservative amount of money and really getting these things to sparkle. So let's just dive a little deeper here in the next slide into what we are looking to do with rents. So as you can see, the 1 bedroom, the average current rent is $1,066 a month, and we're looking to bump that up to $1,350. You'll see with the 2 bedrooms from basically $1,200 to $1,500, and from the 3 bedrooms from $1,431 to $1,700. Now, one of the reasons that we're so comfortable with these numbers are because, as Jonathan mentioned, this team owns another asset that's about 5 minutes away, and we're already getting those numbers, and we feel this asset is better. The other one doesn't have any amenities. It's just a single style building. It happens to be a nice building. I'm happy to own that one as well. But we know we've had a very easy time getting these rents, and we feel these are going to rent even higher. Additionally, we've all been there. Jennifer and I actually were there just a week or so ago, and we like to, fake shop all the other units in the area so that we can see with our own eyes which ones we would rent and for how much. And I feel very comfortable with the average rents that we're going to be looking for. Then let's talk a little bit. Yeah. Tell me.
Yeah, so that product that we already own, it is our best performing asset in our portfolio right now, and it is not nearly as attractive as this one. Has 0 amenities. The unit sizes are much smaller, and we're comping against that asset for this one for our pro forma. So the upside's really significant.
Yeah, no, thanks for chiming in with that color. Although it's already fabulous, we want to come in and improve it even more to just help us bump those rents even beyond what we're putting in the pro forma. So we're going to be sprucing up the outside with some exterior painting. On the interior, we're going to be spending a little over $600,000 doing the kinds of things that I mentioned when we had those interior pictures up. There's a ton of landscaping and trees and such there, and it's fine, just looks a little tired. So we're going to need to do some landscaping work. As you can see, we have $175,000 spent on that. Pool furniture needs to be jazzed up a little bit. We need a new sign. We're going to get some patio furniture as well there around. As I mentioned, there's an outside barbecue area. The dog park is just going to be spiffed up a little bit as well. And then we always like to leave plenty of money as contingency in case there's some unexpected things or costs run over. So we feel that 290,000 there is going to be more than adequate to protect us against anything unforeseen. Jennifer, you want to talk about some of the financing, which is actually, other than location, the best thing about this deal?
Absolutely. So we are getting this asset at a purchase price of $27,500 million. What's significant about this deal that you can't get today is a 69% loan leverage. So we're assuming this note from an existing owner that has owned this asset for 5 years. So we've got to come up with a down payment of $8.3 million. We're getting a loan for 19 million, which is assuming theirs. We have a fixed interest rate at 4.64. When was the last time you heard that? It's been 17 or 18 months. I know that for a fact. And the best part here is we have 9 years of interest only left on this note. So while the plan is to hold it at least for 5 years, we have some options at the end of that 5 years. We could recapitalize and give people their equity back and stay in it and make it a legacy asset for all of us. Or we could sell it to somebody else. And how attractive is this? I know we all think interest rates are going to come back down, but how quickly are they going to come back down? And will they ever hit 4.64 again? So this is just a beautiful note to have. So we've got 9 years left on it, and we'll have operating reserves, which is enough to cover 6 months of expenses at $892,000. And now my favorite part is the next slide, and this is the returns, or excuse me, it's the underwriting. Okay, it's not my favorite piece, but it's still pretty significant and worth talking about. I'm not going to dig in really deep on this, but I do want to bring your attention that we do have a RUBS program on this property, which allows us to collect for 80 to 90% of utilities that we cover for our residents at the property. You'll notice my favorite part though, we've got insurance here. And what I love about Jonathan and Samantha is they underwrote to $1,000 a door, although we've already got a quote to underwrite these units for $400 a door. Now, everybody knows insurance has been going up, but I love that Samantha and Jonathan already took the time and have already forecasted an increase in insurance. So I appreciate that. We'll talk a little bit more about property taxes here, but the bottom line is where I want to bring your attention to. So in year 1, we want to get to a net operating income of 1.4 million. And by year 5, we want to grow this asset to 2.213. That is a difference of $751,000 to the bottom line. And if you put that on a 5.5 cap, if that's what the market is at that time, we have added $13,662,000 in value. And if you put that on a 6 cap, that is $12,542,000 in value to this asset. So again, when Shannon says that this is one of the best assets we've seen in a very long time, this is no joke. It may be the best deal I've ever done in syndication. So super excited about this one. So if we can advance to the next one, this is my favorite part, is the returns. So we're giving an 8% preferred return on this asset. Now, on an asset like this, we're going to have a stabilization period, and that's usually the first 6 months. So around month 7, you could anticipate us starting to pay out distributions, and they will be monthly. Now, it's going to be difficult to hit that 8% in year 1. So let's say we are able to pay out the first half of that in year 1. Now, year 2, we're going into it and we're going to be trying to hit that 8% preferred return, which you'll see we're going to hit that over and over and over. And at the end of our hold period on this asset, a return is looking like we'll have an equity multiplier of 2 times. So if you invest $100,000, you could anticipate getting $201,000 back, and an average annualized return of 20.1%, and a cash on cash of 8.5%. I can't even remember the last time I saw that number. So that's exciting to me. Next slide, please. So again, looking at $100,000 investment, in year 1, we start paying out distributions. You could look at it, a return on your investment at 4.9%. And then year 2, it grows to 8.4, year 3, 9.2, year 4, 9.7, and year 5, 10.1. And so at the end of it, all in total with distributions, you're looking at a return of 2 times what you put in. So 200,702. Next. So this is our sources and use. So again, just reviewing how we're putting the money to use. We have a loan of 19 million. We're going to be investing right alongside all of you. We're going to be raising 12 million on this, and then we'll purchase the asset. We've got closing costs of $686,000. We've got acquisition fee of $962. Operating reserves of $892. Again, that's all the expenses for 6 months, which makes this a very safe asset. And then we have a CapEx budget of $1.4 million. Next. Something that's really unique about this is the management. And I'm going to talk about that right after I talk about due diligence. So one of the things we do, and like Jonathan mentioned, not very many of us live in the Savannah market. So it's really important that we put eyes on the property and we do the due diligence. So we go do an extreme lease audit on the property, and we inspect every single unit before we put this property under contract and move forward. So we've already completed that step. We also are doing a vertical integration, meaning we have in-house property management. So that's something that's unique to John and Samantha's group, and that we all get to capitalize on. And we get the economies of scale since they already have office staff and supervisors there that are doing the turns. And then third is site visits. As we mentioned, Samantha is from the area and they go there regularly to see family. So it's going to be very easy for them to put eyes on this property on a regular basis. And then on management, something we plan to do is just keep you abreast of what's going on in the property. I'm going to circle back to management updates. We will be sending out quarterly updates so you can keep abreast of what's happening and how the turns are going as we progress and hold this asset. Next. This is what makes Jonathan and Samantha and our team different than most syndication groups, is because we do have the vertical integration, we have the in-house property management. And because of that, and what I've already repeated again and again, is the economies of scale. So we're going to really be able to control the rent in the area because we're going to own so many of the assets. And this is just a better asset to own than even the ones we already own. We're also going to do a cost segregation study. That won't happen until after we acquire the property, but that's going to allow us to take the depreciation or accelerate the depreciation for a majority of us on our taxes. And so what that looks like is last year was the last year we were able to have 100% accelerated depreciation on assets that are normally depreciated over 15 years. This year we get to take 80% of the depreciation. And so you're going to be able to take that on your taxes, which I know all of us can use a tax reduction of some sort. You'll want to talk with your tax advisor and see how you can take advantage of that. But that's something that we will, we'll hire that out and we'll be able to produce that and share that with you on our K1s when we produce that next year. And then we also hire somebody by the name of Real Advice, and they come in and they analyze the property and look at all the tangible assets, not just the actual property itself. And they're able to help us keep property taxes down to a minimum, which I know Jonathan and Samantha have already had that experience firsthand and have saved quite a bit of money using them on another asset. If you want to know more about either of these, please reach out to the person that brought you on the call today or this webinar, and they can share with you a little bit more about those two items there. Next. So how to get started with us. It's very simple. We have a great portal that allows you to go in. You'll create an investment profile for yourself. And then you'll want to review all the syndication documents, consult with a financial advisor if needed, read and sign the subscription documents that are out there, and then wire the funds. And one thing we didn't really talk about yet is how soon do you need to get your funds in? So we are planning to close this asset the first week in October. And so if you're planning to use an IRA, we are happy to work with you. We just need to know that that's what you're doing. We know that those take a little bit longer. And for those of you that have never used your IRA, I would love to share with you a really good advisor that can help you get your funds into their financial or their vehicle and start helping you invest as quickly as possible. It usually takes about a week to 10 days for them to help you with that. A lot of financial advisors will tell you they can't do it. And so we can put you in the hands of somebody very capable and competent that we've had a lot of experience with that will give you the service you need to make that possible. And this is a great asset to do it with. So with that, we're happy to open it for questions. Do we have anything in Q&A, or is there anyone?
Yeah, there have been a couple that I've been trying to answer as we go along. This one I think is worth discussing out loud. So they're talking about tenant property rights groups. So one of the things that we look for are states that are landlord friendly as one of the top things that is where we look at properties. And so Georgia happens to be a state that is known as being very landlord friendly. Jonathan, is there anything else about that you think I should say? Oh, we can't hear you though, you're on mute.
No, that is a very good point that I failed to mention in our criteria for finding a market. So absolutely, we need landlord-friendly states first and foremost, and Georgia is extremely easy to work with, especially Savannah as well.
So, Jonathan, I think this other question is best for you to. What factors will influence the timing decision of when we exit the property?
It's really comes down to the market. So our philosophy is how fast can we get all of the investors and our money, because we're investors in this deal, out of it and return it and either make a big return or get an infinite return. So essentially how we do that is just reposition it as quickly as possible. We forecast for an 18-month repositioning period. Typically we get it done in less than half that time, and then we sit and wait until the market's advantageous. A lot of speculation right now that the end of 2025 that there'll be another bottom in interest rates. Who knows? But in the meantime, this asset will be cash flowing extremely well with monthly distributions. I don't know if we mentioned that or not, but they are monthly once we start doing them, until we are in a very advantageous market for either a sale or a refinance.
That's helpful. And someone's asking about the depreciation rate. So we won't know exactly what that rate is until a cost segregation analysis is done after we close. So we don't ever like to make any projections about what that is, but all of us on this call have been doing this a long time, and conservatively, we can tell you that it's going to be typically 50% plus of what you put in.
Yeah, we've been averaging around 60%. So, but no promises. Can I answer this as well? I saw, is there a low projection and a high projection on returns? And just to put some clarification on this slide deck. These are all low projection returns. This is not mid-range. This is not high. We put really what we think is already baked into this deal on our low projections. So the upside is higher, but we're just putting what we feel confident in doing returns on, under promising essentially.
I'm just looking to see here that, so I think we've answered some of these. John, there's a couple questions in there on property management that I think you're probably the best to answer. Do you want to just let your eyes roll over those? While you're reviewing.
Yeah, so
Okay, go ahead.
actually, if Zach wants to ask them and then one of us could answer it, would that work? Zach, you good with
Yeah,
that?
so I think someone asked, please elaborate about the property management Lake City cost charged to property. How often is someone from the property management visiting the property?
Yeah, great question. So most management companies charge 5%. Lake City is charging 4%. And I believe truly that no one is going to manage the asset better than ourselves that actually have skin in the game with the deal. And there will be multiple people on site every single day. So multiple leasing agents and multiple maintenance people to manage this asset. Someone from our executive team will likely be there once a week or once every other week at the very least to lay eyes on it. But we have someone on site every single day.
Okay, thank you. Next, we have, is this a 506B or 506C? And I believe this is 506C. Is that right,
It's-
Jonathan?
No, this is a 506B currently. So that means it's only friends and family. And you do not have to be accredited. We do have a limited amount of non-accredited investors we can take. So we do that because we want this opportunity to be available to our friends and family, which they might not normally have access to these sorts of deals. So that's why we start 506B, even though most folks that invest in this deal are accredited investors, or all of our deals.
Okay. Maintenance is handled internally or externally?
It's internal. So there's full-time maintenance staff who handle all the day-to-day, process the work orders. The only thing that would be external are any heavier lifts to a turn or heavy turns. So carpet or a big painting project or some sort of large replacement of fixtures in a unit. We may bring in outside contractors for that. That's the only situation it would be external. And we already have great relationships with those contractors because we're doing it down the street with an asset that was only 60% occupied when we took it over. It's over 90% now.
Thank you. Next, we have, if this becomes a legacy property, can you simply explain how the original capital is returned and what ratio/return continues? How do you exit a legacy arrangement if desired?
I don't want to hog the panel. Jennifer, do you want to answer that or you want me to? I'm happy to do it, but.
Go ahead.
Okay. So in my opinion, this could very well be a legacy property. How is the original capital reserve return? That is first and foremost our most important question. We will essentially pull as much of that equity out as we possibly can. What we'll do is add a supplemental if we decide to not sell and refinance. And that would just pull equity back to us. So we first have to hit the 8% preferred return. and then we do a return of capital to the investors, and you keep your same equity position throughout the entirety of the deal. So it never changes. Some deals that you might get in, once you get your money back, your equity piece goes away or lowers. That does not happen. So we set these deals up the way that we would want to be treated in the deals. So we set them up the way we look for deals to invest in, and what the criteria we look for in deals that we put our own money in, because we are putting our own money into this deal and all of our deals.
And
And how do
Jonathan,
we?
that question was in here too, a little bit out of order, but I will say that people are asking how much LP equity, and of course we don't have that exact number because some of us are still deciding just how much we're going to put in, but it's typically around 10% of the deal, and this one maybe even more because it is so juicy.
That's right. Yep.
Is that accurate? Okay.
Good point. And how do we exit a legacy arrangement? Essentially, we sell. If the great part of these sort of deals is they're cash flowing very nice. We may be getting infinite returns down the road, and we'll sell if someone gives us an offer that we just can't turn down, which is very likely in these sort of deals when the market gets hot again.
Thank you, Jonathan. And then I guess kind of going off of that, what is the time frame to sell and factors that will influence the decision, which I think you spoke about, but the underwriting assumes a 5-year hold. So the general plan would be to sell in 5 years, but we're going to obviously evaluate the market throughout the hold. And if market conditions permit for us to sell earlier, we will. And if the market conditions aren't optimal in 5 years, the beauty of this deal is we have a 9-year loan, so we don't even necessarily need to worry about needing to refinance or having any of that risk. We have a lot of wiggle room at the end of 5 years, where if the market conditions aren't good, we can hold on for longer and wait it out if necessary. Another question is just asking about the cap rate. So you said 31.4 million in all costs to close versus year one projected NOI of 1.46 million, going in cap rate of 4.69%. Is that market right now?
Yeah, so it's a sub 5 market. Go ahead, Zach. You probably.
Yeah, I think that market right now is sub 5%. Also, typically the way that it's calculated in the market's based off of the purchase price. So you're not going to take into account stuff like the operating reserves or acquisition fees or the CapEx budget. It really just comes down to the purchase price. So if you take that $27.5 million purchase price and apply it to the TTM, so the trailing 12 months before we take over the property, that's a 5.52% cap rate. If you take the trailing 3 month and annualize that, that gets up to a 5.97 cap rate. And if you take a trailing 1 and annualize that, that comes out to a 6.34 cap rate. What I kind of like to do is take the T3 income and then apply that to a TT expense, which is the last 12 months operating expense. That comes out to a 5.91 cap. And if we look at it based on our year one projected NOI, it comes out to a 5.4 cap. So there's lots of different ways you can go about calculating it, but it's safe to say we're probably somewhere in the ballpark of 5.5%. Okay, let's get into the next one. Do LPs get 100% of invested capital back before the 70-30 split? So the answer to that is yes. We need to pay out for each year you're in the deal. We have to pay out an 8% preferred return. And then once we've met that, after we've met the 8% preferred return, then the profits on top of that get split 70-30.
So it makes us work a lot harder.
So the ability to take subject to loan is not a one-time ability.
So just to clarify, are you talking about us allowing someone else to take the loan over? Is that what you're saying, Zach?
I think that's what
Assume the loan.
they're asking, yes.
Yes, he's asking if someone
So
can
we-
assume the loan.
Yeah, that's right. So we can sell this deal with an assumable loan with this low rate again, which makes it more attractive and another option for an exit.
Also saw a few things in here about property management fees and are they fixed and what's included. Jonathan, you want to talk a little bit about how that's underwritten here?
Yeah, property management fees are 4%. They are fixed. They never change. What that includes is essentially running everything inside the property, all the collections, the property management software, ensuring people are getting hired, and we set expectations, follow up, hold people accountable, give them recognition. Just create a culture around the property where they feel like business owners of the property, because that's essentially what they are. They are business owning that property, and they are 100% responsible for the results. And we just hold that person accountable and make sure they get the recognition they deserve for the results they produce.
There's also a question in here about how many maintenance people, part-time and full-time. I know it varies a little bit based on which kind of, how many renovations and things we have going on. But Jonathan, you want to give as much clarity on that as you can?
On maintenance people?
Maintenance
and
people,
payroll?
full-time
Yeah.
on payroll.
It'll essentially be 1.5 maintenance people and 1.5 leasing agents. So one full-time, one part-time of each.
I think we've hit most of the questions.
The other part of
Go
this
ahead.
that we really haven't talked about is this will be our third asset in the submarket. All of them are within 1.5 miles of each other, and none of the economies of scale are built into this underwriting. So when you have those sort of economies of scale, not only material costs, but also labor costs can be shared. This is underwritten as a completely self-sustained asset. So there's other advantages of owning in the same submarket that we haven't, entered into this underwriting as well. So
let's talk a little bit about what people should do when they want to get started investing. So depending on which sponsor invited you here tonight, as soon as this is over, you're going to get an email with a link to the cash flow portal. I see an awful lot of you on here have already invested with us previously, so you'll be familiar with how that works. You can go ahead and log in and sign up, and then we love you to, if possible, within 2, 3, 4 days after making the commitment, to send the money over, and you'll have instructions in there about how to wire. If you are doing this through self-directed IRA and it's going to take a little longer, just make sure and let your sponsor know. And as long as you communicate with us on that way, it'll be fine if it takes a little longer. Have I forgotten anything about signing up, guys?
no, you
Looks
can
like
also do ACHs through the portal as well now, which makes it super convenient.
Terrific. Well, we're really so happy that we had so many of you on here tonight, and you will be getting the recording sometime within a few hours or by tomorrow morning. It takes a little time to download and edit it, clip it up a little bit, but feel free to reach out to any of us with questions, and we look forward to partnering up with you guys on this fabulous, fabulous deal.
Thanks,
Thank you,
everyone.
everybody.
Thanks, guys.
Thanks so much.
Appreciate it. Have a good evening.